CA Foundation students, economics, CA Foundation students who are writing exams in the month of May, that is 2025. I want to give you some economics important topics because I'm expecting a question on some of these concepts. So some students have little confusion, but I don't think so. The major confusion is there. But if you've already attended classes, if you've understood, you would definitely understand the difference and try to watch this for just 5-6 minutes. I'm telling you, this will help you. It's going to be just a revision for you because if this question is there, questions are going to be, answers are going to be very nearby. So you will not get any confusion when it comes to MCQ questions. The concept in macroeconomics we have on ninth lesson last unit, economics main ninth lesson last unit, you have something called international capital movement. I repeat, international capital movement. In international capital movements, there are two very important capital movements, such as foreign direct investment and foreign portfolio investment. Generally, when we talk about investment from abroad or when we talk about capital movement from abroad, we have four important concepts that are given in your syllabus. First important thing is foreign assistance. When we talk about foreign assistance, 100% it is free. You don't have to repay it. Foreign governments can give you grants. Foreign institutions can give you grants like International Monetary Fund, uh, or this World Bank. Okay, these people can definitely give you some funds. Can give some grants. We have tied grants in the sense grant which is tied with some instruction. They would tell you that this particular grant should be used for education, should be used only for roads development or health of the people. Like this, grants will come with the help of some instructions. With some instruction, those instructional grants for which you are supposed to use are basically tied grants. Then some of the voluntary agencies like non-governmental agencies from abroad can also grant some money. So first important capital movement is in the form of assistance or an aid that cannot be 100% sure because we may or may not get. Okay, but this is one source. Second importance is borrowings. Like Indian economy or Indian entities or Indian government can definitely borrow money from abroad. Like directly from governments, you can borrow money. Even from World Bank, International Monetary Fund, Asian Development Bank, you can borrow money. Soft loans, World Bank, organization, International Development Association might provide soft loans where interest rates are very less or no interest rate. Then we have ECB, that is external commercial borrowings, like Indian entities borrowing money from foreign banks. Then we have trade credit facilities. When Indian entity bought goods, the seller might give a credit for a certain number of days within which you can repay. That is the second important source of foreign capital. The third important source is non-resident Indians who are living abroad might deposit money. A lot of people are depositing money in Indian banks or Indian foreign branches, etc. That money can be like, suppose there's a foreign branch in India, foreign bank branch in India, there they can deposit. So that can be one source of foreign capital from abroad. Then the fourth important thing is investments. Investments are of two types. Invest directly, when foreign companies invest directly in the form of establishing branches, in the form of having joint ventures in India, in the form of investing in companies, in the form of subsidiary companies, their associate companies, so on and so forth. Subsidiary company is a company where the holding company invests 51%. Associate company is a company where the holding company invests 20%. So in the form of direct investment, it might come. That is foreign direct investment. The second important thing is we have foreign portfolio investment. This is basically the investment which is made by foreigners in Indian stock market. That means they come and purchase bonds, debentures, shares, equity shares of an Indian company in the stock market. So when the investment comes to stock market in the form of purchasing shares, bond, debentures, that could be called as foreign portfolio investment. When the foreign entity directly come and start their subsidiary company or associate company or a branch or an established a company here, we can call it as foreign direct investment. Now let's quickly look at, I told you there's 6, 7 minutes, maximum 10 minutes, but this is going to give you 1 mark 100%. So 100% will give you 1 mark. So make sure you do not lose this 1 mark at any cost, because sometimes I hear students failing with 2 marks also, 1 mark also in CA foundation. So I expect all the students not to ignore. Last minute revision will definitely help you in any form. And that too, small bits and pieces, if you learn, God knows that can really help you to understand the question. And you will be able to answer that question with 2, 3 marks margin. Also, sometimes you can pass, right? So don't ignore anything during this time, because everything matters a lot and anything can come in the exam. And you can definitely use that information and answer the question properly. So let's get into foreign direct investment. Foreign direct investment is a long-term investment. Usually they invest in any Indian company equity shares more than 10%. The investors can be individuals. The investors can be companies, private companies, public companies, any organizations. And they generally invest in factories, assets, lands, inventories. So this is basically called real capital. And their main focus is opening branches, companies, established subsidiary companies, branches, joint ventures. So if you look at this carefully, it's a long-term investment. They usually invest more than 10%. By investing more than 10%, they would like to have some voting power in Indian entities. These investors could be individuals or companies, private or public companies, or any other organization, trust, even societies also. They usually invest in factories, assets, lands, inventories, where they invest in real capital. They can open branches, they can have joint ventures, they can have subsidiary companies, anything is possible. This foreign direct investment can be divided into 3 types. One is horizontal investment. Horizontal investment in the sense the foreign investor will try to invest. I repeat, foreign investor will try to invest in India the same type of business. That means an IT company in America set up another IT company in India is called horizontal foreign direct investment. Then we have vertical investment, where foreign entity will try to invest in a process or a stage of a production. If in case a foreign entity invest in tire industry in India to support, let's say, Indian car manufacturing industry. I mean, foreign company might invest in supporting, providing raw material, providing intermediate products to Indian manufacturing sector, could be vertical investment. Then we have conglomerate foreign direct investment, where foreign investor or entity or anybody invests in an entity, in an industry which is completely unrelated. So conglomerate is basically a situation where foreign company invest in India, not of the same industry what they do in their country, but in a different industry, unrelated. Horizontal is related to investment in the same industry what they are usually doing in their country. Vertical investment is related to a process, means raw material support or something. Conglomerate investment is basically the investment which is completely unrelated to the home country business. All right. Next, we have portfolio investment. If in case you think I'm going fast, you just go back and rehear once again. This will give you better. But 1 mark I'm expecting. So I'm trying to give you next few days videos, which I honestly believe 100% you will get 1 mark in that concept, whatever. That 10 minutes, if it gives you 1 mark, I think it's better, right? Then foreign portfolio investment. When it comes to foreign portfolio investment, they invest in financial capital, that shares, bonds, debentures in Indian stock market. They could be depositing in Indian bank. They could be purchasing Indian shares. Their intention is not voting power. Their intention is not any control in the management. They just want to invest money, take a return and go off. That's it. So indirectly, the intention is remuneration. That means when they invest here for a short term, they want some returns on the investment. Whenever there is an issue, I mean, there is any political instability or economic instability, anything, they just pull out investment and go. That's it. They usually invest less than 10%, and they're short term in nature. They're highly speculative. In case, depending on the economic and political issues, If they think that they're not confident that their investment is safe in India, there's every possibility they withdraw the investment and go back. Okay, this is foreign portfolio investment. This lecture is for CA Foundation students, economic syllabus, 9th chapter, and all part B economics, macroeconomics, 6th lesson to 10th lesson. There are some concepts bit by bit. If I give you one or two, every class of mine for the next few days is going to give you 1 or 2 marks, 1 or 2 marks. So like this, with 10 classes I'll give you, I can confidently give you at least 20 to 25 marks. Okay. Next, foreign direct investment, foreign portfolio investment, basic difference you see. It's a long-term investment, it's a short-term investment. Why it is long-term? Because they came here, they established here, why will they go simply, right? They invest in physical assets, they invest in financial assets such as shares, bonds, debentures. Aim is to increase their production capacity and they want to have some control. They don't want to have control. And they might bring technology, resources, etc. They don't, they just bring capital in FDI. Then they normally get into primary market. In stock market language, when you directly invest in company, it is a primary market situation. Instead of investing in company directly, if you go to stock market and buy shares from an existing shareholder, it could be secondary market. Then entry and exit is very difficult because you have set up here, you have joint venture, you bought assets here. So FDI exit is very difficult. Entry is also difficult sometimes, unless and until Reserve Bank of India has given automatic route, you may have to take some approvals. Whereas here, entry and exit in stock market investment is little easy compared to FDI. And most of the FDI investors, they're expecting some control in the company, they're expecting management in the company, they're also expecting profits in the company. Whereas here they're expecting capital gain. I bought the share today. If the share price increases after 1 or 2 months, I will just sell it off and go off. That's all. That's why it is called short term and speculative. When they speculate market in such a way, depending on the economic and political situations in the country. If in case they think that the situation is not stable, they definitely pull out the investment and go off. And it's not speculative. Direct impact on employment. When we have foreign direct investment, foreign companies, foreign entities are directly establishing, they're investing more than 10%, they're investing in assets, they're setting up joint ventures, branches, and they're also investing in subsidiary companies. So 101% for a host country, in the sense the country which is receiving investment is called host country. This country, 100% will have better benefits in the form of employment. Okay, and mostly, I suppose if the foreign portfolio investors have invested in stock market, in bonds, debentures, etc., they might expect some interest, etc. I mean, they are not interested in management control, they're not interested in voting power, they're only interested in return. So FDI is long-term, more than 10%, expecting voting power and control. FPI is short-term, investing less than 10%, not expecting control and voting power. Got it now? Yes. For Indian economy, like developing country like Indian economy, 101% most important investment option for us is FDI. For developing countries like India, 100% FDI is the better option because it has the potential to create employment opportunities and definitely it will push national income and economic growth itself. But for advanced countries, generally, FPI is the better option. Okay, so this foreign direct investment and foreign portfolio investment, I'm 100% sure 1 or 2 marks will be coming. One to guarantee some concepts which I'm going to explain will give you 2 concepts also. The students who are writing, especially this is meant for the students of CA Foundation who are writing in the month of May, please make sure you don't miss the video. So if you subscribe only, you'll have a notification. Then with that notification, you can be benefited. And if in case your friends are preparing, and if you really think that this is more clear, so please share and subscribe. Have a good day. Thank you so much.